Well, Grayson, welcome back to the podcast.
Thanks, Rob. It's great to be here again.
Yeah, well, here's something that maybe not all of our listeners know about you. When you were fresh out of school and starting your investment career, you didn't actually start on the equity side, right? You were on a different part of the capital structure. You started as a credit analyst.
Yeah, it seems like a long time ago in a different world, but in many ways, it's actually pretty similar when I switch to the equity side. You're speaking with management teams, you're doing discounted cash flow models, you're trying to understand themes out there, you're trying to understand how the cash flows of a company are going to shift over time, and understand the risks in a business. And it's really just the last stage that is a little bit different, where you know what you need to know about the business itself. And then you just have to determine which you're going to invest in. Is it going to be the kind of corporate bonds, or are you going to invest in equity in that part of the capital structure? So yeah, well, it seems like it's vastly different in many ways. If you do real in-depth credit research or equity research, really a lot of the stages are the same. So the transition was relatively easy. That was a great background and a really good way to kind of understand risk better, I think.
I can imagine. And well, those who listen to the podcast will know that we had our global credit portfolio manager, Brian Carney, on the podcast recently. And I think he summarized current conditions in credit markets as being both convergent and complacent. That was his assessment. You mentioned that they're not terribly different. I'm curious whether you agree with Brian and whether that extends to equity markets as well.
I don't think Brian knows what he's talking about. No, I'm just kidding. I agree with Brian. Yeah, credit spreads are tight when you look at the market. Certainly, I follow it a lot less closely than Brian does these days, but I still keep tabs on it a bit. And yeah, when you look at investment grade spreads, for example, or as I'm sure he's mentioned many times, I know he does internally, are on the tight end of things. High yield spreads are also on the tight end of things, kind of indicating you don't have to pay a big premium to get people to buy debt. And so that generally means that people aren't pricing in a whole lot of risk. They're willing to take on that risk for a lower yield. One thing that's kind of interesting is that we seem to be at a bit of an inflection point. And so while credit spreads are quite low and people seem quite complacent, it seems like we might be in a new era of higher capital spending, which impacts both equities and fixed income. So when you look at what's happening in the world right now, there's a bunch of themes that seem to lead to higher capital spending, which is kind of unique because the last decades really has been a period of kind of lowering capital spending, right? It's kind of just-in-time delivery, so you have less inventory in your system.
There's been people and prognosticators talking about, buybacks and how that, is the opposite of investment and how we should have more investment. It sounds like that's shifted.
Exactly. You're exactly right. And you think about what are some of the things that are happening now? Well, artificial intelligence or AI, of course, that's enormous amounts of spending that you're seeing. You're seeing kind of nationalization or reshoring of assets, where you're building semiconductor fabs in the States, or you're building auto plants. Spending on space, you're seeing SpaceX or Amazon building rockets or building satellites to feed these internet networks. Self-driving vehicles are expensive. You're going to have a fleet of Waymo cars that drive you around San Francisco or Austin. That's going to cost a ton of money. We're unfortunately seeing a lot more defense spending in the world now. So you're seeing a number of those big capital projects that are starting to take a lot of money and a lot of capital for bondholders and equity holders. And I guess the real question over the next 5 or 10 years is going to be, is the return going to be there? You get a pretty good initial return, which is why people do it. Or you build the first couple of data centers you build, or AI data centers you build, or great. People are excited. You can, hopefully capitalize on that somehow and make money off it by selling subscriptions if you're ChatGPT or Anthropic. But the question is more, well, that's great for the first 10 or 20 or $30 billion. But, if you spend $400 billion next year between the big companies, and maybe you spend $400 billion or $500 billion the next year, and then the next year, are you going to get a 10% or 20% return on that capital, or is that going to start to diminish pretty quickly? And, we've seen that in the past, which is a typical cycle with, in 2001, for example, there was a massive amount of fiber that was laid down or wireless telecom networks that were put in place. And it turned out that there was too much, at least for that time. Same thing with 2005 through 2009 with housing.
Housing stock, yeah.
A lot of people were buying a second home just to sit empty in Florida to speculate on housing prices, and turned out that wasn't really needed. And so that was a disaster after that. The combination of complacency and capital spending right now, that's kind of unique in environments. So we have to figure out if we're going to start seeing diminishing returns in some of those markets.
Not too long ago, I think it was a study from MIT that came out claiming that 95% of companies, so far at least, are seeing no returns from generative AI. And I think even Sam Altman of OpenAI was speaking recently just about concerns on exactly that topic of return on investment, at least in the shorter term. What sort of signs would you look for to see whether that return is coming through or if it isn't? Because certainly there are pockets of the market that have climbed in terms of equity prices on, from my perspective, a big assumption that, yeah, these returns are substantial and they're coming and they're enduring.
Often in these real bull markets, you tend to get a couple things. One, there's just such desperation to kind of take part in it that you tend to get overbidding of assets in many ways. And so you hear stories of some of the big tech companies, the big hyperscalers and others who, are so desperate for data centers and for power that they're basically talking to everybody that they can in North America that might be able to provide some power. And so sometimes when that happens, you get kind of conflicting messages, right? Because you hear that there's so much demand for these assets, but it's hard to tell that, maybe the demand is actually the same person asking, 20 different people if they can provide power for this facility, or if they can build a data center. And they don't need 20 different facilities. They just need maybe two right now, but they're just trying to figure out, well, who's going to be the fastest to build one that we want. And then we'll go with those two, and then we'll kind of scrap, the rest of them.
This is like the open table problem. Like you can no longer just book 10 different restaurants and then pick once you're there. It's not 10, you're not going to sit at 10 different tables at once.
Exactly. So I think that's one of them. And then it's going to be a question as well of just utilization. I think we'll see that. I think early on we saw some feedback on some of the early AI that it was kind of neat, but it kind of got to a plateau reasonably early. And so people were using it at work, for example. I'm thinking of some of kind of Microsoft properties like Copilot. And it really, initially, people were really excited about it, wanted to use it, saw all these kind of neat features. It could summarize meetings, and it could take notes for you and write emails and these kind of things. And then I think it faded a little bit before it improved and got to the next phase where people found new ways to use it. So I think that will be the kind of leapfrogging situation we see going forward too. We'll have to watch for that to see whether people find it actually useful or just kind of fascinating, where, I can write haikus and it can do kind of fun stuff like that. But it's not actually saving you a bunch of work, right? You can ask a ton of questions. In our job, we do a bunch of research, as you are well aware, and it can be helpful to have AI act as a bit of an analyst and do some kind of work for you in the background. You can ask it to, research this industry or the competitors in this industry, or who's grown over the past several years. So I think it'll be a question of seeing how useful it is for some of those, and whether a lot of those are necessary or they're just kind of fun to do at the time, and it doesn't really change your workflow 3 or 4 years from now. So watching workflow and how companies change their workflow, I think, will be important over the next several years.
You spend a lot of time speaking to management teams, assessing management teams. I presume in every conversation, the manager is going to claim how transformative AI has been for their business. Are there genuine use cases within the portfolio that you've seen that are like, this is a step function change with respect to that return on the investment? Or are we still early to really evaluate that?
It's going to be a little bit like software and the internet was 20 years ago, where it, at first you're not really sure how to use it. And there may be these phases where it takes you a while to figure out kind of how to use this new technology. So with AI, there's a bunch, and there's a number in our portfolio that are pretty interesting, that I think are finding ways. And what we've tried to do is find ways to benefit from AI without really trying to bet on one winner, one type of technology that's going to be a kind of a win or lose technology. And you've heard this from us a number of times. It's really trying to hedge our bets a little bit, benefit from the theme with a bit less risk. And so I'll give you a few examples. on how we're trying to diversify our beneficiaries on AI. One is Amphenol. So this is a company that makes interconnects, which are the wires that connect many devices. And so part of the thesis with this is that they can benefit from AI or digitization of kind of the electronification of the world. And so whether it's your car, fancy infotainment system, or windows that have power to kind of go up or down, or even have power that if you put your finger in it, they'll stop, kind of like a garage door, and they won't crush your finger if you're pushing the up on that. So just all these different additions need different interconnects to use them. In addition, they are now providing interconnects for NVIDIA for their racks. Looks like a brain, more or less, where you see those old images of a brain that just have all of the different synapses connected together. So they provide the wires for that. So there's ways you can benefit really kind of directly. There's also companies like Texas Instruments, which makes analog chips, which are really the opposite end of the spectrum. These are chips, microchips that connect the real world to the digital world. And so if you think about how do you get an audio signal like you or I talking into the digital world, well, you need to have an analog chip do that. And how do you kind of bring it back out so you can hear it? Well, you need a digital chip for that. Or how do you measure temperature outside? That's another kind of backdoor way you can benefit from AI, because AI needs a lot of data, and a lot of this data is measuring things in the real world. And so that's been another area that has really, we think, seen an inflection point where it's allowing companies to use AI to automate stuff that they couldn't before. So you think about the world over the last 20 or 30 years, most people can probably picture a automotive plant. These are the pictures you see of these big robots
All
with
the
kind of
robots.
arms.
Yeah.
The reason you see that mostly in the automotive industry is because it's super expensive to do, and it has to be something that you do over and over again, and you have to do it millions of times. If you're just making a electronic toothbrush or something that you're making in pretty low volume, it's really hard. It costs so much money to automate it in the past that it's really not worth it. We're also investing in machine vision companies that can benefit from AI.
And enabling a return on that investment for their customers, I suppose, if they can do it a lot more cost effectively. Grayson, I want to go back to something you said earlier, just on this notion of we're in an era of greater capital expenditure. Of course, much of it comes from the bottom up, individual companies. But one thing that happened in your universe more recently was the US government taking a stake in Intel, I think just about 10%. I want to get your take on that. I mean, it borders on some of these topics of chips, of the need for spending. So what's the historical perspective on the US government and sort of more state-led capitalism? Feels foreign, but I'm sure it's happened previously.
It does seem like a big shift. And I think a lot of people will, when they hear things like that, will envision countries like China, which recently, in the last several years, President Xi in China basically kind of asked big tech over there to share some of their profits kind of for the common good. And the stock market, didn't really love that. Investors didn't really love that, because basically you thought you had X dollars in profit to do something with, and it turns out you had X minus something dollars to do something with, and somebody else had the rest of it. So that wasn't great. And then we also envision countries like Russia, which has had a government that's been highly involved in the lives of their citizens for decades and decades. And, if you look back over the past 100 years, Russia hasn't really done that well, despite having unbelievable resources there. You compare it to Canada or the US, for example. But I think, the US or North America has gone in waves over time. And so I think it's not the case where there's been no government involvement ever in anything. We've been in a period of what I'd probably characterize as more privatization, less government involvement over the past 30 or 40 years. You think about kind of Reagan or Thatcher and some of these, it's kind of generally a thinking of lower involvement by the government, often lower taxes. NASA, for example, I mean, that's been kind of a government agency that's been very successful in the last number of years, a bit more kind of privatization of that, where you've seen the government using SpaceX rockets or ULA rockets to send people to space. There's been other cases too, and it's typically been around things like bankruptcies or wars where you see more privatization. bankruptcies are things like the financial crisis in 2009, where we remember TARP funding, where the government took stakes in Citigroup, B of A, AIG. And that was basically to prevent a collapse. So that's really the one area you've typically seen it in. But the government hasn't really wanted to do that, I think, in the past. Clearly, they don't want big industries to go bankrupt or to a run on the bank. But they put money in to kind of save the system.
I guess that's what feels different about this one. I mean, I certainly remember the financial crisis and some of the equity stakes that the government came in to take. AIG would be one example of many. I imagine in the aftermath of the Great Depression, the government played a more active role in that regard too. Now, I suppose there's a case you could make that, hey, Intel is in trouble, and therefore, a company that deserves quote unquote rescuing by the government. But it does feel different. This feels more strategic in nature. And presumably, there are other companies that we own in the portfolio that, I've seen being floated as, potential other candidates where the government might be interested in a stake. I'm thinking particularly of defense companies.
Yeah, I think you're right. It is kind of unique because it's typically either bankruptcies or often wars will be the other one where you see the government getting involved. And that's typically where you see them getting involved in critical industries. We've seen that with steel mills and coal mines during World War II or the Korean War, or telecom
We're
assets
seeing it
in
now
World
too
War
with
One.
US Steel. Yeah.
Yeah, so exactly. And so that's you're right, where it feels different today because we don't seem to be in an active war. And so it seems weird that you would need to take ownership in some of these assets, even if you do think they're critical assets. But yeah, there does seem to be a bit of a shift. We've seen big infrastructure programs over the past 8 or 10 years. We've seen kind of healthcare enlarge. Now we're seeing Intel, of course, which I guess is being built it as a critical infrastructure and that it makes chips. Now we're talking, there's been some rumors of defense companies thought of as potential targets for nationalization. I'm not really sure what the benefit of it would be for the defense industry. And when we think about it, it's a pretty good setup now in the US for both parties. The defense companies don't make egregious returns. The government's well aware that they're one of the only customers and certainly the biggest customer of a lot of these companies. And so they don't pay them enormous sums of money to do the work. It's already pretty secretive. So it's not like just because they're public companies, they have to tell, your enemies everything you're doing, big portions of their portfolios, they say nothing about. And so there's no kind of secrecy, doesn't appear to be any kind of secrecy issues there. But I suppose there could be some benefit. I'm not sure. Maybe if you wanted to keep stuff more out of the public eye, maybe if you didn't want to have returns on capital to be part of the equation at all. Now you have to see a lot of the spending goes through the big defense companies. I guess if they were all owned by the government, you wouldn't really see any of that spending. So they could spend 10 times as much as they wanted to and not tell the public about it. But it does seem like there wouldn't be great benefit in our mind kind of moving down that path.
In terms of your work, Grayson, looking at individual companies, and we've spoken about a few of them, what does all this mean? Uncertainty on return on investment. I mean, we haven't talked about some other kind of big macro things that are happening with respect to rising bond yields, a weaker US dollar. It all feels like this should raise the cost of capital for companies, and yet markets are still extraordinarily strong. Does that square for you?
It does seem a little bit off. I agree. It kind of goes back to our initial conversation of complacency at the start. There's a lot to be excited about, clearly. We've got a lot of new technologies like AI that the markets are super bullish on and feel like it could be something that changed the world. You're also talking about self-driving vehicles, talking about potentially sending people to space. So there's a lot of things that are exciting and could potentially change the world and perhaps get really high returns on those. But it also does seem like there's a lot of risks in these transitions. We've seen this over the last number of years where there's been a lot of kind of false starts on different technologies that people were extremely excited about, and they'll probably pan out at some point in the future. But that path isn't always linear when you think about things like Bitcoin or blockchain. You think about things like EVs, even electric vehicles. There's been great excitement, and then there's periods like now where it seems like they're while still growing, they're much less in favor. There is even kind of financial instruments like SPACs, which are kind of different forms of companies a few years ago that people were ultra excited about and trying to buy every single company that came out that IPO'd under that format. So there's been a number of different kind of financial or technological shifts, and not all of them have played out immediately. And so I think that's part of the challenge. And you're seeing, from a macro standpoint, we don't think a lot of the underlying factors have changed all that much that could cause higher discount rates that may lead you to want to kind of demand more compensation for taking these risks. When you think about things like inflation, well, it seems like the market is a little bit less worried about it now, and it's less in the headlines. A lot of the factors that drive it are still around. Think about reshoring of assets. Well, that's expensive, right? If you already have a plant in Taiwan that makes semiconductors and you're just going to build another one to do the same thing in the US, well, you perhaps didn't need to do that. Or same with a big auto facility. If there was a facility in Korea that was making cars and you demand that they make them in the US now, well, that's another facility that you spend billions of dollars on that is doing the same thing. Or for labor costs, if you want your T-shirt or your deck chair to be made in the US instead of in China, well, the labor rates are more expensive. So that's what you're going to have to deal with. And so a lot of those costs are probably going to stick around. And so it seems like the market is not overly worried about that, at least in the short to medium term. You've seen that with rates falling down in the short end of the curve. The 30-year end of the curve is still staying a little bit higher. So that's giving you a bit of a sense for what some people are worried about, that, well, maybe the inflation and some of the changes that you're seeing out there with kind of Fed funds rates lowering may be necessary or not necessary in the short term, but they may have implications in the long term. So that's what we're trying to balance as investors, is trying to find companies that aren't overly impacted by these macro changes and that can benefit in a number of different scenarios.
For a company like Northrop Grumman, what does it mean that there might be the risk of the government taking an equity position alongside you as an investor?
Yeah, it's tricky to know. I mean, on the surface of it, it seems like it could be somewhat dangerous, just in that it appears to take out the kind of the free market dynamic, where you have a stakeholder involved that may not kind of play by all the same rules as the rest of the investors in the free market. And that's been kind of a push of the US and other democracies and capitalist countries over the years, is that, hey, the government kind of stays away because the market kind of knows what's best and will allocate money in the best way possible. And that will typically be based on where you get returns. And if there's no returns to be had, well, that often means that
the invisible hand takes care of things.
Yeah, it's not an area to invest. And I think there's probably a couple areas that I'd exclude from that have been highly beneficial over the years. That's been things like really early stage research. So that's something that universities do really well and the government has done really well in the past, where there's not going to be a payoff for 5, 10, 20 years, but the payoff is going to be enormous. And so you think about things like sequencing the genome or the internet, where the government put a bunch of money into these and the payoff was many decades down the road, but the payoff was enormous. And so that was an unbelievable investment and a very kind of savvy move for the government. And so that's the type of things you want the government involved in my opinion, because private companies just don't have the time horizon to do that, even ones like Google.
Well, I think one of the best books I read over the last several years was Chip Wars, which opened my eyes to just the role of the Defense Department in funding a lot of the early stage ventures in terms of chips and technology that, are so abundant today. Which I guess explains why the Intel thing might make sense. But where do defense companies like Northrop Grumman fall in that spectrum?
Yeah, it's a little tougher. It seems, if I were in the government, it seems like you'd want to keep pushing on these new technologies, like you say. Certainly China's doing this, and you're seeing this more in life science companies like Waters, for example, where they're really trying to push on early stage research in order to kind of see the benefits many years down the road from new pharmaceuticals or new life science equipment. Defense is perhaps one of those, like you say. It could be something where you get new technologies that emerge from real kind of cutting edge technologies that are happening in defense, and those kind of go on to be used in commercial aerospace, for example. That's possible, and it seems like that's probably happening now. It's not clear to me that there's a huge gap missing where it's just, hey, there's not enough defense spending. They're not spending enough on cutting edge technologies that are going to, have kind of leveraging effects in the economy 10 years from now. But maybe there is something. I'm not. Maybe there's something that we just don't see, that the government or others are aware of, that really needs and deserves a lot of spending and could benefit the economy 20 years down the road.
Well, I was going to end by asking you, Grayson, what, we've talked a bit about risks, but what's really exciting for you in the universe today? And, you spoke to a machine vision company that we added to the portfolio a bit earlier. Waters, another business that you've been adding to so far this year.
So Waters is a life science company. So they make tools. And so these are tools that you can use in research or drug testing, things like liquid chromatography or mass spec equipment. One of the core uses for them, for example, is testing drugs. So white pills, the pills you might take for medicine. Yeah, really must have equipment for quality control. Waters had a new management team came in a few years ago, and we've been really impressed with them. CEO, CFO are both fantastic, and they've really improved the business. And more recently this year, they made an acquisition that is actually of a part of a business that we also own. So they bought part of Becton Dickinson. Becton Dickinson is a company that, their core business was making needles. So if you've drawn blood or something like that, you might have seen a BD symbol on the needle. So that's kind of their historical business. But they're selling a non-core business to Waters. And at first, the market didn't love the acquisition. And we had a feeling that maybe it wasn't, it was actually quite appealing. And so we spoke with management team a couple of times and really kind of dove into the details. My colleague, Chris, did a bunch of work on the business, understanding the technology, understanding what they were going to try and do with this technology. We really think it's going to make a real positive difference for the company. After speaking with them for a couple hours, we found that they had a really clear plan on what to do with these assets. And that's one of the kind of reasons we speak with management teams is we've spoken with thousands over the years. And when you've spoken with that many, it becomes kind of quite clear who really knows what they're talking about and doesn't know what they're talking about, doesn't have quite the plan. When you talk with Waters, they can tell you exactly what they're going to improve with the assets they bought. This is what can be operated better. This is how we're going to change. Here's the 4 things we're going to change. Here's the reason we bought these assets. So that was how we really became more comfortable with it. Is it became quite clear to us that they had a great strategy and they had a real plan for execution after buying these assets. And so we added that position, and we're pretty excited about the outlook for it.
Fantastic. So yes, definitely lots of themes in the world, but it's great to hear that when it comes down to the core of it for us, it's about finding these businesses, speaking to the management teams, understanding how they fit from a portfolio perspective in terms of what's going on in the world. But Grayson, thank you so much for spending the time. I loved your characterization of the world of CapEx that we're in today and the big question, what's the return on that CapEx and when will it come? Thanks so much.
Thanks, Rob.